Travelers just pulled off something that shouldn't be possible. The premiums it wrote were basically flat, revenue barely moved, and yet earnings per share jumped 57%. Here's how a company grows the top line by nothing and the bottom line by more than half. Look at the three numbers side by side. Total revenue grew 0.3% to $12.2 billion. Net income rose 46% to $2.2 billion. And diluted earnings per share climbed 57% from $6.53 to $10.26. Same premiums, wildly different profit. For a property and casualty insurer, that's not a contradiction. It's the entire business model. The magic number is the combined ratio, claims plus expenses, divided by premiums. Under 100% means the underwriting makes money on its own. Travelers came in at 83.6%, one of its best ever. But strip out the weather and the underlying combined ratio was 84.1%, barely better than last year. Translation: the reported profit soared mostly because the hurricanes didn't come. Catastrophe losses were $518 million, down from $927 million a year ago. So what actually drives the profit? Management calls it the earnings engine, and it has four parts. Underlying underwriting income, the durable core, just topped $1 billion after tax for the 8th straight quarter. Net investment income rose 14% to $883 million as the bond portfolio rolls into higher yields. Add light catastrophes and $578 million of favorable reserve releases, and core return on equity hit 24.9%. And this isn't just one lucky quarter. Revenue has climbed every single year, from $34.8 billion in 2021 to $48.8 billion in 2025. The franchise underneath is genuinely growing. A bigger book, higher investment income, more scale. The engine is real. What swings quarter to quarter is the weather sitting on top of it. Here's the detail almost everyone missed. Net income rose 46%, but earnings per share rose 57%. The difference is share count. Travelers bought back $1.33 billion of stock this quarter alone, shrinking its diluted shares from 229 million to 214 million. Since 2006, it has retired roughly 70% of its shares, quietly handing every remaining owner a bigger slice of the company. The three segments tell the strategy. Business insurance, the core, grew to a record $6 billion in premiums, with prices up 4.8%. Bond and specialty jumped 14%, powered by a 40% surge in surety bonds tied to data center construction. And personal insurance actually shrank 8%, on purpose, as travelers walked away from underpriced auto and home policies rather than chase growth. You can see the swing right in the earnings line. Net income to common went from just under $3 billion in the catastrophe-heavy 2023 to $6.2 billion in 2025. Diluted earnings per share more than doubled over those 2 years, from $12.79 to $27.43. The trend is up and to the right, but notice how far it can dip in a bad weather year. So what's it worth? At about $369, Travelers trades near 9.9 times trailing earnings, but almost 13 times forward earnings. The market's way of saying this year's profit is unusually high. Under a normalized earnings framework, a base case lands around $330 to $360, with a bearish case near $250 and a bullish case in the low 400s, right where the freshest Wall Street targets sit. That's implied value under stated assumptions, not a price target and not investment advice. Which brings us to the catch. A quiet catastrophe quarter and big reserve releases don't repeat on command. Management itself targets a mid-teens return on equity over time, well below the 24.9% it just posted. When the people running the company tell you the number won't last, it's worth believing them. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description. The bottom line, Travelers is a best-in-class insurer whose durable engine is genuinely strengthening, but whose quarterly earnings will always swing on catastrophe luck. This was a lucky quarter on a strong franchise, and the stock has already re-rated to a record high. Watch the underlying combined ratio, not the reported one. If this was useful, subscribe for the next filing, broken down the same way.